Lately I've been giving something a lot of thought. Here I sit in Omaha, in the same familiar office, at the same old desk, and I keep hearing whispers, or rather pronouncements, about an impending market crash. They're saying 2026, give or take. The truth is, this isn't my first rodeo. I've weathered, what is it now, 14 or 15 market crashes. I've honestly lost count somewhere along the line. But the amusing part is this: each and every time, people react as if it's a completely unprecedented event, succumbing to panic. They liquidate their holdings, vowing to never invest again. And then, inevitably, the market rebounds, as it always does. And those same individuals are left standing on the sidelines, watching as others reap the rewards. Now, I'm not going to pretend that I possess some crystal ball that tells me exactly when the next crash will occur. Nobody does. Anyone who claims to have that kind of foresight is either being dishonest or trying to sell you something. Probably both. But what I can offer is some perspective on how to approach it, how to prepare for it, and, most importantly, how to capitalize on it. Because you see, a market crash isn't a calamity, it's an opportunity. It's akin to the greatest fire sale you'll ever witness. And if you're well prepared, that's precisely when fortunes are made. Let's rewind for a moment, back to 2008. The global financial system was teetering on the brink. Banks were failing. People were losing their homes. The stock market plummeted nearly 50%. I remember sitting in my office, glued to the ticker, and it was grim, truly grim. News outlets were proclaiming the end of capitalism as we knew it, drawing parallels to the Great Depression. But do you know what I was doing? I was buying. I invested in Goldman Sachs. I invested in General Electric. I poured $5 billion into companies that everyone else was desperately fleeing, and people thought I'd lost my mind. "Warren, what are you doing? The world is collapsing." My phone wouldn't stop ringing. People I hadn't heard from in years were calling to tell me I'd gone off the deep end. But I knew something they either didn't know or had forgotten in their panic. I knew that America wasn't going anywhere. I knew that solid, well-managed companies don't simply vanish because of a couple of rough years. And I knew that when fear grips the masses, that's the time to act. There's an old adage, be fearful when others are greedy, and greedy when others are fearful. I didn't coin that phrase to sound clever. I coined it because it encapsulates the entire game, really. And I learned that lesson the hard way, through decades of observing human behavior play out in the market. Now, let me share my perspective on market corrections. Most people view a crash as a loss. Their portfolio shrinks by 30%, 40%, and they feel impoverished, as if someone has reached into their pocket and stolen their money. But that's not how I perceive it. If you're not selling, you haven't actually lost anything. Those are merely numbers on a screen. The underlying companies are still operating, still producing goods, still serving their customers, still generating revenue, and often still paying dividends. What has truly changed? Only the price. And a lower price, well, that's advantageous if you're a buyer. Consider it this way: if your favorite breakfast cereal is on sale at the grocery store, half price, are you going to complain? Of course not. You're going to buy 2 boxes, perhaps 3, maybe even stock up for the entire month. Stocks are no different. When the market crashes, it's like the entire stock market is having a massive clearance sale, with everything marked down significantly. And yet, people stampede towards the exits, trampling one another in their haste to escape. It defies logic, doesn't it? But that's human psychology at play. That's fear. And fear, unfortunately, can drive intelligent individuals to make foolish decisions. Now, I'm not suggesting that you blindly throw money at just anything during a market downturn. That would be reckless. It would be akin to buying every item in the clearance bin simply because it's cheap. Some things are inexpensive for a reason. You still need to exercise prudence. You still need to understand what you're buying. But here's the crucial point. If you've done your research beforehand, if you've been following companies, analyzing them, understanding their business models, and patiently waiting for the right price. Then a market crash is your moment. It's like being a farmer. You don't sow seeds in the midst of a drought and expect them to flourish. You wait. You prepare the soil. You monitor the weather. You get everything in order. And when the rains finally arrive, that's when you plant. The market operates in a similar fashion. You prepare during the prosperous times, and you act decisively during the challenging times. That, in essence, is the entire strategy distilled into a single sentence. Let me tell you about Coca-Cola. I acquired Coca-Cola in 1988, investing approximately $1 billion. It was the largest investment I had made up to that point. And people questioned my rationale. Warren, why Coca-Cola? It's just sugary water. What's so remarkable about sugary water? And I would respond, well, yes, but it's sugary water that people have been consuming for a century, and they're likely to continue consuming it for another century. You see, I can reasonably predict that. I can't predict the next revolutionary tech gadget. I can't foresee which social media platform will dominate in 10 years. Those things are too transient. They lie outside my circle of competence. But Coca-Cola? I understand Coca-Cola. People adored it in 1888, they adored it in 1988, and they still adore it today. That's a fairly reliable track record. That's what I seek. Straightforward businesses. Businesses that are unlikely to vanish. Businesses that even a moderately competent individual could manage. Because sooner or later one will. I actually borrowed that line from someone, but I can't recall who. It was probably Charlie. Everything worthwhile I've ever said likely originated with Charlie. Now, during the 2008 financial crisis, Coca-Cola's stock price declined. Did the company's underlying business deteriorate? No. Did people cease drinking Coke? No. They may have shifted from purchasing it at restaurants to buying it at grocery stores to economize, but they continued to consume it. The stock simply became more affordable. If I hadn't already been a shareholder, I would have loaded up the truck and bought even more. That's the key. You don't need to uncover the next groundbreaking tech stock. You don't need to gamble on a startup that might become the next Amazon. You don't need to grasp artificial intelligence, blockchain, or the latest buzzword. You simply need to identify mundane, predictable, exceptional businesses and patiently wait for them to go on sale. You know, I believe many people misunderstand the true nature of investing. They think it's about generating quick profits, engaging in frequent trading, timing the market, scrutinizing charts and indicators and all that jargon, moving averages, RSI, and I don't even comprehend half of it. But that's not investing, that's gambling, that's speculation. And look, I'm not going to claim that no one ever profits from gambling. Some people do get lucky, but that's the operative word, lucky. Investing, genuine investing, involves owning a portion of a business and allowing that business to generate wealth for you over the course of years, even decades. It hinges on patience, and patience, well, that's the most challenging aspect because when the market crashes, maintaining patience seems nearly impossible. You witness your account balance dwindle day after day. Your friends are in a state of panic. Your family is questioning your well-being. The news is blaring about the imminent collapse of the world, and every fiber of your being is urging you to take action, sell, get out, cut your losses, anything. But the optimal course of action is to do nothing. Or, even better, to buy more. Let me share a brief anecdote. Back in the 1970 seconds, I acquired a textile company called Berkshire Hathaway. It was the worst investment I ever made, by the way. A dreadful business, a dying industry. I bought it because I was angry with the individual who ran it. That's never a sound rationale for acquiring a company. I was young, I was naive, and I was attempting to teach someone a lesson. And do you know what I learned? The market is indifferent to your ego. But in any event, in the early years, I was managing funds for a group of investors, limited partners, as they were known. And the market was highly volatile, surging one year, declining the next, and stagnating for years on end. This was the 1000. 960 seconds and 70 seconds, not a particularly favorable period for stocks. And I recall one of my partners approaching me, genuinely concerned. A pleasant fellow, a dentist, I believe, or perhaps a physician. He said, "Warren, should we sell? Should we get out? I'm losing sleep over this." And I responded, "If you can't stomach watching your investment decline by 50% without panicking, you shouldn't be in the stock market." It sounds harsh, I realize, and I felt remorseful for saying it, but it's the truth. Because the market will decline by 50%, perhaps even more. It's not a question of if, but rather when. And if you're going to liquidate your holdings every time it declines, you'll never generate any wealth. You'll simply buy high and sell low repeatedly. That's the absolute worst investment strategy imaginable. And yet, that's precisely what the majority of people do. Now, let's discuss what you should actually do when the crash arrives. First and foremost, don't panic. I know, easier said than done. Believe me, I understand. Even after all these years, even with all my experience, there's still a little voice in the back of my head during market downturns whispering, maybe this time is different. But it never is. It feels different. It always feels different. In 1987, it was program trading. In 2000, it was the dot-com bubble. In 2008, it was subprime mortgages. Every crash has a distinct narrative, but the conclusion is always the same. The market recovers. So remain calm. A crash is not the time to make impulsive decisions. It's the time to adhere to your plan. If you've been investing consistently, continue to invest consistently. Don't halt your contributions. Don't try to time the bottom. Don't try to be overly clever. Simply continue to invest your funds. It's known as dollar cost averaging, a sophisticated term for a simple concept. You invest a fixed sum each month, irrespective of the market's performance. When prices are high, you acquire fewer shares. When prices are low, you acquire more shares. Over time, it all evens out, and you end up performing quite well. Better than quite well, in fact. You end up outperforming most professional investors. Second, create a list. Before the crash materializes, I want you to sit down and compile a list of companies you would be delighted to own, companies you understand, companies that produce goods you use, companies that you believe will still be in existence in 20 or 30 years. Write them down, study them, ascertain their intrinsic value, determine what constitutes a fair price, determine what constitutes a bargain price, and then simply wait. And when the crash occurs and those companies go on sale, you'll be prepared. You won't be scrambling to figure out what to buy. You won't be paralyzed by indecision. You'll already know. You'll simply be waiting for the price to reach your target. It's like attending an auction. If you arrive without knowing what you want to bid on, you're likely to make mistakes. You're likely to become swept up in the frenzy. You're likely to overpay. But if you arrive knowing precisely what you want and precisely what you're willing to pay, you're likely to secure a favorable deal. Third, maintain some cash reserves. Now, I'm not advocating that you hoard cash indefinitely, waiting for a crash. That's also a mistake. Because if a crash doesn't occur for 5 years, you've forfeited 5 years of potential gains, and those gains compound. That's a significant opportunity cost. But having some cash on hand, perhaps 10% or 20% of your portfolio, provides you with dry powder, the ability to act when everyone else is frozen. When everyone else is forced to sell due to excessive leverage, financial constraints, or sheer fear, you can buy. It's like possessing an umbrella. You don't carry it around every day, hoping for rain, but when it does rain, you're grateful to have it. And in the stock market, it rains with some regularity. You know, people frequently ask me, "Warren, what's the best investment you've ever made?" And they anticipate that I'll cite Coca-Cola or Apple or some stock that generated billions of dollars in profits. And those were excellent investments. Don't misunderstand me. Apple, in particular, I was slow to recognize its potential, but it has proven to be quite rewarding. But the truth is, The best investment I've ever made was in myself. I dedicated my 20 seconds and 30 seconds to reading, learning, studying businesses, visiting libraries, reading annual reports, researching other investors, and engaging in conversations with intelligent individuals. I didn't possess substantial capital back then, but I had time, and I utilized that time to improve my understanding. You see, that's the essence of investing. It's not solely about money, it's about knowledge. The more you know, the better the decisions you'll make. And better decisions, well, they compound over time, just as money does. Perhaps even more rapidly than money does. So, if you're young, if you're just beginning your investment journey, don't fixate on accumulating a large portfolio. Focus on cultivating a robust intellect. Read voraciously. Learn how businesses operate. Study accounting, not the intricate aspects, but the fundamental principles. Learn to interpret financial statements. Learn how to think critically. Because when the crash inevitably occurs, those who have done their homework will be prepared. They'll know what to do. And those who haven't will simply be fearful. They'll be contacting their friends, seeking guidance, and their friends will be equally apprehensive. Now, let me share something that might surprise you. I don't think about money in the same way that most people do. I mean, certainly, I possess a considerable amount of it. More than I could ever spend, more than anyone could ever spend, really. It's somewhat absurd when you contemplate it, but that's not my motivation. I don't awaken each morning contemplating my net worth. I don't examine my portfolio and feel wealthy or impoverished based on its fluctuating value. I engage in this pursuit because I relish the game. I enjoy discovering exceptional businesses. I enjoy watching them flourish. I enjoy the intellectual challenge it presents. It's like playing chess, but the pieces are companies, and the board is the entire economy. And the crash? The crash is simply a part of the game. It's a challenge, a test. Can you maintain your composure when everyone else is losing theirs? Can you discern opportunity when everyone else perceives disaster? Can you act decisively when everyone else is paralyzed? That's what distinguishes the competent investors from the exceptional ones. It's not intelligence, it's not education, it's temperament. Let me tell you about my partner, Charlie Munger. Charlie passed away not long ago, and I miss him dearly every single day. We worked together for, what was it, 60 years? Something along those lines, more than half a century. We spoke on the phone nearly every day, and Charlie was more intelligent than I am. I'll concede that readily. He won't mind me saying so now. He could anticipate events that I couldn't even fathom. He read everything, philosophy, psychology, physics, history, everything, and he synthesized it all in ways I never could. But you know what Charlie taught me that was most invaluable? He used to say, the big money is not in the buying or the selling, it's in the waiting. The waiting. You see, most people are incapable of waiting. They become restless, they become anxious, they feel compelled to do something, they want to feel productive. But the best investors are comfortable doing nothing, even for years at a time. They acquire a great business, and then they simply hold on to it. They allow it to grow. They allow it to compound. They don't monitor the stock price daily. They don't fret over quarterly results. They simply wait. And 20 or 30 years later, they awaken to find themselves wealthy. It's not complicated, but it's not easy either. Because waiting requires discipline. It requires confidence. It requires ignoring everyone around you who's doing something different. You know, I often think about my father. He was a stockbroker and lost a considerable amount during the Great Depression, and I suspect that's why I became so fixated on not losing money. I witnessed the impact it had on him. I witnessed the impact it had on our family, and I made a decision at a young age, probably around 6 or 7 years old. I resolved to never experience that feeling, to never be in a position where I was desperate, where I was compelled to sell something because I desperately needed the funds. So I've always been conservative, perhaps excessively conservative at times. I have 2 rules, you know. Rule number 1, never lose money. Rule number 2, never forget rule number 1. People assume I'm joking when I say that. They laugh, but I'm not joking. You see, if you lose 50% of your money, you need to generate a 100% return just to recoup your losses. That's a long and arduous journey, and some people never recover. So, the key is to avoid losing it in the first place. And the way you accomplish that is by being patient, by being disciplined, by not engaging in foolish activities, by not utilizing leverage, by not betting everything on a single idea, by not panicking during market downturns. It's unexciting, I know, but it works. So, let's discuss 2026. I don't know if the market will crash then. Perhaps it will, perhaps it won't. Perhaps it will crash in 2027 or 2025 or tomorrow. It's ultimately irrelevant because crashes are inevitable. They're an inherent part of the market. If you're going to participate in the stock market, you're going to experience market crashes. That's simply the reality. But let's assume that it does crash. Let's assume that the market declines by 30%, 40%, or 50% over the next year or two. What will you do? Will you panic, liquidate your holdings, and hide under your bed? Or will you take a deep breath, retrieve that list of companies you've been diligently researching, and begin buying? Because I assure you, the individuals who buy during the crash are the ones who prosper on the other side, not the ones who sold, not the ones who panicked, but the ones who remained composed, the ones who recognized the sale for what it was. Let me share something else with you. During every crash, every single one, people proclaim, "This time is different. This time it's exceptionally bad. This time the system may not recover." I heard it in 1987. I heard it in 2000, I heard it in 2008, and I'll undoubtedly hear it again next time. And you know what? It's never different. Oh, the specifics are different, the narrative is different, but the outcome remains the same. The market recovers, America recovers, business continues. Why? Because people continue to innovate, they continue to solve problems, they continue to awaken each day with the intent of improving things. And as long as that's occurring, the economy grows. And if the economy grows, the stock market grows. It's really that simple. Now, I want to address something uncomfortable: fear. You see, during a crash, you're going to experience fear, genuine fear, the kind that keeps you awake at night, the kind that induces stomach discomfort. You know, I believe one of the most significant mistakes people make is to believe that investing is intricate. They assume you need sophisticated software, insider information, and a grasp of complex derivatives and option strategies. But that's simply not true. Investing is straightforward, not easy, but straightforward. You identify a good business, you acquire it at a reasonable price, and you hold it for the long term. That's it. Everything else is just noise. The talking heads on television, noise. The hot stock tips from your brother-in-law, noise. The predictions about the market's trajectory, noise. Just concentrate on the business. Is it a sound business? Does it generate revenue? Will it still be generating revenue 10 years from now? If the answer is yes, buy it and forget about it. Let me tell you about a mistake I made. In the late 1990 seconds, during the dot-com boom, everyone was profiting from tech stocks. And people constantly inquired, "Warren, why aren't you buying tech stocks? You're missing out." And I would respond, "I don't understand them. They lie outside my circle of competence." And people assumed I was old, out of touch, past my prime. And you know what? For a while, they were correct. I was missing out. The Nasdaq was increasing by 50% or 100% per year. But I adhered to what I understood: mundane, established companies, banks, insurance companies, consumer goods, and then the bubble burst. All those tech stocks that everyone was so enthusiastic about plummeted by 90% or 95%. Some of them went to zero, and suddenly, being unexciting didn't seem so undesirable. The lesson is to remain within your circle of competence. Don't pursue things you don't comprehend. It's acceptable to miss out. Truly it is. It's preferable to miss out than to lose everything. So, as we contemplate 2026 or whenever the next crash materializes, I want you to remember a few key principles. First, crashes are normal. They're even beneficial. They purge the speculators, They reset valuations. They create opportunities. Don't dread them. Anticipate them. Prepare for them. Welcome them. Second, focus on businesses, not stocks. When you acquire a stock, you're acquiring a stake in a business. So think like a business owner, not a trader. Would you sell your business simply because the stock market declined? Of course not. So why would you sell your stocks? Third, be patient. This is the most challenging, but also the most crucial. Wealth accumulates gradually, very gradually. But if you afford it sufficient time, it compounds to incredible proportions. I've been investing for 70 years now, perhaps longer. I'm 94 years old, I believe, maybe 95, I lose track. And I've witnessed a great deal. I've witnessed wars, I've witnessed recessions, I've witnessed booms and busts, and everything in between. And throughout it all, the stock market has trended upward, not in a straight line, certainly not. There have been numerous years where it declined, sometimes for several consecutive years, but over time, it has trended upward because the American economy grows, businesses grow, innovation occurs, people solve problems, and if you own a share of that, you get to participate in the rewards. It's really that simple. Now I want to leave you with one final thought. Investing is not about being the most intelligent person in the room. It's not about possessing some secret formula. It's about being reasonable, being patient, and not engaging in anything foolish. That's it. That's the entire secret. If you can accomplish that, if you can remain composed when everyone else is panicking, if you can buy when everyone else is selling, you're going to be more than okay. You're going to thrive. In fact, you're going to build significant wealth. It won't happen overnight, not within a year, and realistically, probably not even within 5. But with time, through consistent effort, like a snowball gaining momentum downhill, it will happen. The snowball begins small, gradually accumulating snow as it rolls. It grows progressively larger, and by the time it reaches the bottom, it's enormous. That's the power of compounding, the essence of wealth creation. So, when that market correction arrives in 2026, or whenever it does, remember this: the crash isn't the end, it's a fresh start. It's your opportunity, your chance to acquire outstanding businesses at remarkably attractive prices. Don't squander it. Don't allow fear to steal this opportunity from you. You know, someone once asked me, Warren, what single piece of advice would you offer a young investor? After careful consideration, I replied, read voraciously and cultivate patience. That's the essence of it. Educate yourself, learn the landscape, and then patiently await the opportune moment. And when that moment arrives, act decisively. All right, I believe that's enough wisdom from this old man for now. Go out there, do your due diligence, compile your watch list, and when the time is right, be courageous. Because on the far side of fear lies opportunity. That's where true wealth resides, and that's where you need to position yourself. I genuinely wish you good fortune. And always remember, it's not about timing the market. It's about your time times the market. Maintain your investment, stay patient, and remain disciplined. In 20 or 30 years, you'll reflect on the crash of 2026 and realize it was the pivotal moment that changed everything for you. The moment you started building your fortune. Now, where did I leave my Coca-Cola? You know, some things never.